to the Orlando Real Estate Buzz. I'm Brendan Rendo with the Homes in Orlando team at Next Home Neighborhood Realty. And Joe is on a plane right now, supposed to be getting home. So fortunately, he won't be joining us today. We still have a lot to go over. Of course, we're going to start with the Fed cutting rates a quarter of a point, what that really means and what are we missing that may be affecting that behind it. And then some numbers in the economy that really should be warning signs about the residential market moving forward. Some of it has to do with commercial real estate. Some of it has to do with debt of the consumers right now. So we're going to go over that. And then we're going to go over Orlando's numbers as always. And just a absolutely dismal week for Orlando home sales. So let's get into it. And welcome to the Orlando Real Estate Buzz. Well, as expected, everyone knew it. No one was surprised. There had been some talk the past couple of days. Oh, they're going to cut half a basis point. But of course, that didn't happen. Nothing to really drive that half a point cut. But, they did do their quarter point cut. Kind of left the door open for additional cuts this year. Probably, I think they probably will do two more. Maybe October and December. I think they may skip one. I don't think they're going to do three cuts going through the rest of the year. There's such mixed economic information out there right now, and there was something semantically that Greenspan changed today that was different from previous meetings earlier in the year. And that semantic is, where did he put inflation and where did he put jobless claims? He actually switched them. For much of the past year, he's really always come out, hit the inflation number. Our target, our goal is 2% inflation and low unemployment. That's their mandate that they're trying to reach on a regular basis. And they came out, they did the quarter point cut. They cut to 4.1 or 4.0 for their overnight rate. But he was emphasizing jobs more than he was the inflation. And he mentioned something, that the risk to both is high right now. The risk for higher inflation is there, and the risk for higher unemployment is there. And I think a lot of that had to do with the revision of all these jobless numbers that we've had. The revision of the removal of 911,000 jobs from March of 2024 to March of 2025. You think about it, if he had had those numbers earlier, would they have done the cut earlier? I think they would have. I do think they would have. Even though the inflation rate has stayed well above, he says moderate, I say well above. Currently for the year, they're projecting 2.9%, but that's also removal of the food and energy. So two of the most major things that affects everyone's pocketbook, they've taken out. And they're saying, well, that's going to be 2.9%. And then he said their projection for next year, 2026, is 2.6%. And then, oh, look, by 2027, we may get down to 2.1%. So that was kind of a red flag to me, that they're not going to have a super tight, hawkish view of the lending rate for the next year. I don't think they're going to be super aggressive the way Trump would like them to be, but it's going to be much more moderate than a lot of the hawkish Fed members would like it to be. And it's interesting because How does that affect the housing market? How does that affect um, mortgage rates, all that? And we saw leading up to it that the mortgage rates, based on the 10-year T, took a nice dive. We dropped really to I think it was the lowest yesterday before the meeting, came down to roughly about, I think the average was 6.22, somewhere in that ballpark. But something that Joe and I have always warned you about is watch the rebound. Watch what happens after the meeting, because so many times people overprice the discount and they immediately jump back. And this is what we're seeing today is we've gone from roughly a 4.04 early this morning to a jump of 4.122. So mortgage rates are going to start heading back up today. And we warned you about that, is that don't get over exuberant, don't get overexcited, because what we usually find is that the market prices everything in before the actual cut happens. And that's exactly what's happened here, is they priced it in. Now the yield is going to start going up. And there's a couple of reasons why I think we're going to continue to see this yield go up. Some interesting things have happened that we haven't seen in a long time. One of the biggest ones is, for the first time in nearly 30 years, foreign central banks hold more gold than U.S. Treasuries. What is happening is we're seeing, I think, the total debt of the world is something like $315 trillion. So there's not a lot of strength. There's not a lot of faith in the fiat currency, because there's nothing really backing it. It's no longer backed by gold. It's paper. It's how fast you can print the money. And we've seen the value of the U.S. dollar, you can follow that watching the Dixie, has dwindled. Where it was strongly above 100%, it was 104, 105 for several years. We're now dropping down to roughly about 97. So when you look at the yield on the Treasury bonds, and then you look at what gold is yielding right now, it makes much more sense for the central banks of foreign countries to buy gold over U.S. Treasuries. And that's going to cause a huge problem going into the end of this year. And that problem is something that we continuously talk about, and we continuously hammer home, which is we've got to refinance somewhere, I believe it's in the neighborhood of $9 trillion. We're going to borrow another $1 trillion. We still have October, November, and December, and most of September, or December, and most of September, that the government is going to be borrowing another $1 trillion. From who? I don't know. I don't feel like lending them money. So you've got to borrow another $1 trillion. Plus, you have to refinance. I believe it's. I hear different numbers, 6.5. I hear $9 trillion, but it's an enormous amount of debt that has to be refinanced roughly before the end of the year. And what you're seeing with this graph is that foreign countries don't want our debt anymore. And you can see the amount of foreign central banks, foreign countries that own our debt since 2015 has slowly and consistently dwindled. And the holdings of gold has continuously gone up. So what they're saying to the U.S. is gold is a safer haven than your U.S. Treasuries. We have more faith that we'll be able to hold our value with gold more than the U.S. Treasuries. And what is that going to do? You're going to see this graph, this U.S. 10-year Treasury, the U.S. 30-year Treasury, all the Treasuries, these yields are going to have to push higher in order to refinance, in order to pull people in to the market. And I truly believe that's why earlier this year, Bassett and the others did away with the reserve requirements on U.S. Treasuries. That was part of the bank's requirement that even if you were holding U.S. Treasuries, you had to have a 10% reserve. They did away with that. Why? Because that 10% is needed to buy the new debt or the refinance debt. But you're not going to have $6.5 trillion of that debt. So what I see one, your mortgage rates are not going to get down to what we saw when they were just printing money freely and they dropped the overnight rate to zero. You're not going to see it. You're not going to. I quite honestly, almost 99% certainty, I can tell you, you're never going to see it again. So if you're sitting there and you're waiting and you believe that, oh well, the Fed's going to cut 2 more times, mortgage rates are going to go down. Not necessarily. More than likely, no, they're not. And that's because of all this continuous debt that we have. So when you're sitting there and you're thinking, oh, maybe should I wait? Should I go move ahead? Should I wait? Should I move ahead? Right now is an absolutely fantastic time. If you're a buyer, take advantage of it. Take advantage of it because you're going to see from the numbers from this week that you have a huge advantage over the sellers right now. And it's all tied to this. Do I think rates are going to go lower? No, I don't. I just don't see the market for Treasury bonds and bills getting better in the near future. Not unless we cut our spending and cut it dramatically. Then yes, then I think we've got a shot. But otherwise, no. I think the yields are going to continuously stay higher. And one of the other things that we're seeing is the debt of everyone. And this is a major one. Commercial mortgage delinquencies have now surpassed 2008 during the financial crisis peak. This is always a precursor to the residential. The commercial market usually runs about a year and a half ahead of of residential real estate. So when you started to see all the store vacancies, all the for lease, the stopping of commercial properties being built, that was an early signal back in 2005 that holy cow, something big is coming down the horizon. And the residential market trails commercial usually by about 12 to 18 months. So that is a big warning sign that the housing market may be in for an even bigger correction than what we're going through right now. So you've got that. And then here's another concern is that the average credit score just fell its fastest pace since the Great Recession. Why is that? Well, very simple. People aren't making their payments. People on their car loans, on their credit cards, on their student loans. That's been one of the biggest things. I've had 2 clients who we couldn't finance simply because they didn't make their student loan payments. Student loan payments started back up, I believe it was in February or March. They had not made a payment. They make payments on every single thing, and they didn't make the payments on the student loans. And they lost over 100 points in their credit score. And the student loan payments weren't a whole lot. I think one was $39, one was $40. But because they are delinquent on their student loans now, we could not get them a house. And we're going to be probably another 6 months to 8 months to be able to get them back up, to get the credit score. They're making their payments. They're getting back on time. But you've got to rebuild. Sometimes time is the only thing that helps credit scores. So you've got to look at all this. And then the national debt for credit cards right now, it has jumped to $1.21 trillion. Everyone's paying their bills with their credit cards. It's a systemic problem through our government, through the way we live. And at some point, it's going to crash. In Orlando right now, bankruptcies are at one of its highest levels in ages as well. So all this is factoring into what has now become a completely stale housing market for Orlando and for the rest of the country. I mean, it really has become extremely stagnant. It's because everyone's tapped. We're just tapped out. You go to reach into your pocket for five, go to the grocery store, and it's hard to walk out with 5 items under $30. And it's not just me, it's everyone it's affecting. So it's frustrating because you're looking down the road, and I see the rest of the year 2026 still being, for the housing market, stagnant. And how is everyone else reacting? Well, the builders in August pulled back their new home construction starts by nearly 8.5%. And then here's our sales for Orlando for the past week. This was shocking. These are actually the lowest sales numbers for the Orlando area this year. Bottomed out. I'm hoping this truly is the bottom for this year. Single family homes decreased to 339 sales during the week of September 7th. That is dismal. Plain out dismal. And what are we seeing? We're seeing the inventory decrease. Why? Sellers are just not going to sell their houses when the market is this slow. Have we seen a little uptick the past week since rates dropped a little bit? Yes. Was it major? Not really. When you look at the number of new mortgage applications that came across, more of it was refinance than it was home purchases. That's a red flag out there as well. Then we look at our condos. 74 condos. That is it. I mean, this market, if you're trying to sell a condo, you have really got to be willing to take a price cut, willing to swallow your pride and realize that if I want to sell it, I'm going to have to sell it what the real market bears due to the increased HOAs and due to the competition. And then the inventory decreased again. Then when we get into the monthly numbers, here it is, months of inventory, 6.14. And what do all the old school cards say? 6 months of inventory, that is a buyer's market. By definition, old school. And we see in the $1 million home area, they're sitting at roughly 9 months worth of inventory. And then our original list of sales price, we look at this every week. We're sitting just above 92%. So there's that 8% discount over what people originally list the price for. And that's what you're seeing. You're seeing price cut after price cut after price cut after price cut. And what you're seeing from builders, incentive. So if you have the ability, it really is a good time to buy. It's a great time to buy. And just know that you're in the driver's seat. And if you don't like the deal, walk away. You've got the ability to walk away and say, no, that's not what I want. And they're going to call you. They're going to call back in 2 or 3 days, in a week. You can call back in a week, 2 weeks. 95% chance that house is still sitting on the market. Take advantage of it. It's the opportunities are there. Then our average days on market, 70 days. So this continues to stay high. And then here it is. We look at it, weekly sales graphically, and you can kind of see it right here. It just kind of is a straight downward since June, straight downward path, absolute straight downward path. And we're going into months that generally aren't higher sales months, October, November. December usually peaks a little bit, simply because a lot of people like to do things before the end of the year. But no, October, November usually steady, but not blowout months. People are back to work. People, you've got schools in session. People don't necessarily like to move during that time frame. So you're going to continue to see these numbers stay, I think, at the 400 or below, even with the little bump in savings that you're going to get from the better interest rates. Then our total actives, here you go, decreasing slowly but surely. And that's, quite honestly, that's typical this time of year, but it's still, a lot of it is frustration from sellers just don't want to have their houses on the market anymore. Then this is a concern. This I have been watching is our short sale numbers are starting to blow up. We went up again this past week from 69 to 79 homes with short sales. And this number, I think over the next year, we're going to see this just continuously to increase. That's because we're getting to that point where people, even though they've been in their homes for 2 or 3 years, have to move. And with the market softening, they don't have the increase in the equity to cover the cost. They've took out either 3% down FHA, 3.5% down FHA, maybe a 3% down conventional, or even I've unfortunately had to do 2 VAs where they were 100% financing, and there was just no money there to cover all the costs of selling. Plus, the values had come down because they were in newer communities. So that's a big concern. I expect that to continue to grow. Then here we are looking at the condos, months of inventory. What that means, if we sold every property, it would take 13 months at the current sales rate. 13 months. That's huge. That is a complete buyer's market. And you are starting to see the prices just absolutely crash in the condo area. And I think it's probably going to be anywhere from about a 30 to 35% correction in the condo market. And then here you are in the 500 to $1 million. 24 months. 24 months of inventory right now. That is humongous. Average days on market, 102. So even with the Fed cutting rates, mortgage rates coming down a little bit, is it enough to spark the housing market at this time? I don't think so. I don't think we're going to get the bump that everyone thinks we're going to get. All the people out there, oh yeah, the Fed's cut the rate court. Oh my gosh. If that's what you're looking for your savior in purchasing a house, totally wrong. Totally wrong. It's not the way to approach it. And you've got to budget. You've got to be willing to make some sacrifices, be willing to get your credit scores up. The higher the credit score, the better the rate you get, and stay within your means. There are opportunities out there, and you really don't even have to look that far anymore. So as a buyer, take full advantage. As a seller, set your goals realistically. If you're up 50% from when you bought the house in 2017 and you have to settle with a 45% profit, it's okay. It's all right. You'll be fine. I know house prices have gone up, but still think you're going to be better off, with settling with a 1%, 2% less than having to try and push it and sit on that for a while. So I know it's kind of a pessimistic discussion today, but I want to be real with the numbers. No fluff, no bullshit, no crap. That really bugs me when you see people out there just pushing stuff that is falsehoods in a lot of way. And owning a home is still the American dream, and I want to help as many people achieve it as possible. But sometimes it takes a plan. Quite honestly, I think it always takes a plan. you need to know exactly where you sit and exactly how to get there. And that's what Joe and I both try and do with all of our clients. So if you ever have any questions, ever want to know why are they doing this? Why are they doing that? Reach out. Always feel free to just, give us a call, hit us up on YouTube, Instagram, wherever it is. We're here to help. We're here to make home ownership a reality for you and for everyone else. So thank you. We appreciate you joining us today, and have a blessed week. And we'll see you again next Thursday on the Orlando Real Estate Buzz. Please like, subscribe, and join us every week. Bye-bye.